We start off with that big call from the Treasury Secretary. In an interview this morning, Scott Bessent telling Bloomberg that the Fed should cut rates by 50 basis points next month and that ultimately rates should be 150 to 175 basis points lower than they are right now. That got us wondering, what would that mean for the market, starting with stocks? The S&P and Nasdaq hitting records today, but it was a long underperforming small cap Russell 2000 that saw the biggest gains. Do out-of-favor groups and sectors rebound if rates drop? I think we would all agree that equities would probably rally. Where would the rally be most pronounced?
Well, you're seeing it in the small caps, no question about it, and I think Karen's spoken about this as well. I'll say this, and we talked about it last night. It was this time last year that the market started pricing in 6 rate cuts for 2025. And the market, through the lens of the S&P, was significantly lower. So the market has rallied. Now we're starting to talk about more rate cuts. Personally, I think it's all priced in. But quickly, I find it fascinating and listening to Treasury Secretary Bessent talk about the reasons for these rate cuts are the softening job market, which, you know what? Maybe it is a softening job market. With that said, what we heard from the administration last week was those revisions were rigged and it was a political hit job. So my point is you really can't have it both ways. Either the job market is softening and the revisions are legit, or the revisions weren't legit and the job market is robust. So pick a side, I guess, is my point.
I agree with that.
Yeah, so I agree with you, agree with me on the small cap, which that's not news, right? But to the extent that there is borrowing there that is fixed, that could be set lower, that's huge. I think anyone with a not great balance sheet. Also, if you look at who has really been hurt by higher rates, which is some of the commercial real estate, right? We've got a lot of paper coming due. To the extent that that could be cheaper, that would be a good place to rally. But also, it's just math in that discounted cash flow. If you're using a lower rate, you get a higher multiple, higher stocks.
Yeah, the fact that the stock market in certain sectors has run ahead of that. And you guys just mentioned the Russell 2000 small caps. Look at Homebuilders today. I mean, huge. Like, just the fact that they are already kind of going in there and taking that performance, whether it happens or not, is a very odd thing to me. I get the reflex sort of reaction to some degree. I think a lot of investors are looking to play catch up in some areas that they think have been kind of suppressed because of the high rates.
Yeah.
But then you think about it this way, okay? Like last year at this time, the same debate was happening about the labor market. And, I think the Fed at that point was probably a bit more confident that with 3.2% CPI, I think that was the July number or so at this point, that it was going down in the direction that they wanted it to go down. The market was not pricing in a trade war at that point, right? And you had unemployment that was below 4%. And right now we're at 4.2%, right? And then GDP growth, the first half of 2024, was basically 1.25%. Well, that's where we were this year. So for all intents and purposes, the big change right here is that unemployment's going the wrong way, part of this dual mandate, and now inflation, part of the dual mandate, is probably not going much lower that quick. And so I just think about this from a growth perspective. The thing going forward, if we have 15% base rates on a lot of the imports that are coming in, and then many from China at 30%, that has to weigh on growth. And, I think I just said this, or I heard him say it earlier today or something like that, is that we just really haven't seen, I guess, the headwinds from higher prices just yet. We've seen plenty of scenarios, whether it was the autos, where the companies were willing to kind of eat that cost right now. But a lot of them, if you still see unemployment going higher and you see growth, they're not going to be able to do that.
Nothing happens in a vacuum, right? And so the impact of tariffs could still yet be felt, Tim. But at the same time, the offsets could be lower rates, lower borrowing costs, other savings from the One Big Beautiful Bill in terms of, expensing research and development, for instance. There are other offsets potentially that could help growth, even if tariffs weigh.
Yeah, and I think that's the whole argument for rates. I think the administration is arguing that too, that there is an unnecessary headwind, whether it's 150 basis points, I don't know. And my guess is that hedge fund manager Bessent felt a lot different about the Fed's role in stimulating the economy than Treasury Secretary Bessent feels. I also think the conversation we often have on the desk, we had a bit of it last night, which is that we don't know what the long end's going to do. We know that on the short end, that really does help those folks that are pinned to short-term borrowing and those dynamics that really are moving. The yield curve has steepened. We also know, and we had this conversation also last night, that liquidity is extremely high. So I think equities will continue to rally. And I think, back to your original question is what performs in that 150 basis point cut environment? I think you're barbelling this thing. I think you're grabbing high multiple tech where those discounted cash flows are farther out in the future. They make less, they don't make money, et cetera, or the ones that don't make a lot and have very expensive price to sales ratios. Those are going to rally. I think the mega caps will. And then I think the other side of your barbell is the value part. And look at where we're starting to get some breakout. We've had the breakout in financials. They will continue to do well. Look at healthcare. Today was a really interesting day in healthcare. There's a lot of headwinds from Washington there, but I think that's another place to play.